Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. I've produced over 800 videos with more than 380,000 watch hours as of May 2025. I also focus on regional and global economic trends. Today we're diving deep into a fresh analyst report that's making waves in the SGX food and beverage space. CGS International just dropped the hammer on Delphi Limited, slashing their target price by over 19% and downgrading the stock from add to hold. But here's what caught my attention. This isn't just about one company struggling. This downgrade tells a much bigger story about global supply chains, currency headwinds, and a chocolate industry under siege. Let's start with the numbers that matter. CGSI cut Delphi's target price from $0.88 to $0.71, and they're forecasting earnings per share to drop by 15 to 17% over the next 3 years. That's not a small adjustment. That's a fundamental reassessment of the company's prospects. The analysts cited 3 key concerns: elevated cocoa prices, a weaker Indonesian Rupiah, and deteriorating consumer sentiment. When I see a combination like this, it signals that we're dealing with both structural and cyclical challenges. Now, let's talk about what's really happening behind the scenes. Cocoa prices have absolutely exploded, hitting 60-year highs in 2025. We're talking about prices reaching nearly 10,000 per metric ton. That's unprecedented territory. This isn't just affecting Delphi, it's crushing the entire global chocolate industry. Barry Callebaut, one of the world's largest cocoa processors, is forecasting a mid-single-digit drop in sales volumes for 2025. Even giants like Hershey and Mondelez are cutting production forecasts. When you see industry-wide pain like this, it tells me we're not dealing with company-specific issues, but with a fundamental supply-demand imbalance. The root causes are fascinating and alarming. Climate change, El Niño weather patterns, and widespread crop diseases have devastated cocoa-producing regions for several consecutive seasons. What's particularly concerning is that this crisis is happening alongside escalating trade tensions. The 2025 trade war has introduced new tariffs and supply chain disruptions that are making an already difficult situation even worse. Companies like Lindt are literally shifting their entire North American supply chains to Europe to avoid these trade barriers. But here's where it gets interesting for Delphi specifically. The company generates a significant portion of its revenue from Indonesia, and the Indonesian Rupiah has been under pressure throughout 2024 and into 2025. When your primary market's currency weakens against the US dollar, which is how Delphi reports its financials, you get hit with a double whammy. Not only are your local revenues worth less when translated back to USD, but your imported raw materials, including cocoa, become more expensive in local currency terms. Let me share my perspective on this situation. While the challenges are real, I think the market might be overreacting to some extent. Yes, cocoa prices are at historic highs, but commodity cycles are just that. Cycles. The question is whether Delphi can weather this storm better than its competitors. Looking at their Q1 results, revenue only dropped to $149.8 million, which was actually in line with consensus estimates. More importantly, their free cash flow surged to $34.4 million from $23.1 million in the prior year, and their cash balance improved to $74 million. This tells me the company is managing its working capital effectively despite the headwinds. What's particularly encouraging is that Delphi maintained market share in Indonesia through increased promotional spending, and they saw robust growth in the Philippines. This suggests their brand strength and distribution network remain intact. The 27% drop in EBITDA is concerning, but it's largely driven by currency translation effects and one-time promotional investments rather than fundamental operational deterioration. From a regional perspective, Southeast Asian consumers are becoming more price-sensitive as inflation pressures mount, but they're also increasingly drawn to premium chocolate products. Delphi's focus on premium segments could actually position them well as the market recovers. The company's agency brands business did see some weakness as partners reduced promotional spending, but this is likely a temporary cost-cutting measure rather than a permanent shift in demand. For Singaporean investors, this situation presents both risks and opportunities. The broader theme here is currency volatility and commodity price inflation, factors that affect many SGX listed companies with regional exposure. If you're holding Delphi in your CPF investment scheme or SRS portfolio, you need to consider whether this fits your risk tolerance. The 6% dividend yield is attractive, but it might not be sustainable if earnings continue to decline. What I find particularly relevant is how this connects to Singapore's economic outlook for 2025. The government is projecting 2.8% GDP growth, driven partly by electronics and trade-related services, but the manufacturing sector, which includes food processing, faces headwinds from supply chain disruptions and trade tensions. Delphi's challenges mirror broader concerns about how Singapore-listed companies with regional exposure will navigate this environment. The currency dynamics are especially important to understand. With the Monetary Authority of Singapore potentially considering a policy band adjustment later in 2025, if growth and inflation weaken further, we could see additional volatility in regional currency relationships. This could either help or hurt companies like Delphi, depending on how policies evolve. If you're finding this in-depth analysis valuable, imagine the level of detail you'll get with our daily premium content. For just $1 a month, you can become a member and unlock exclusive insights, deeper dives, and more to help you navigate the Singaporean investment landscape. Don't miss out on this opportunity to level up your investing journey. The link to join is in the description below. So what's my take on CGSI's downgrade? I think they're being appropriately cautious given the near-term headwinds. But the 11 times price to earnings ratio for 2026 is sort of miss that underpins their $0.71 target price seems reasonable. The key question is whether cocoa prices will start normalizing by late 2025 or early 2026. If they do, Delphi could see a significant earnings recovery that would make current levels attractive. My advice for investors is to treat this as a cyclical downturn rather than a structural decline. If you believe in the long-term growth story of Southeast Asian consumer brands and you can handle the volatility, dollar cost averaging into a position over the next few quarters could work well. Just make sure you're not overweight in commodity-exposed stocks in your overall portfolio. The broader lesson here is about the interconnectedness of global supply chains, currency markets, and trade policies. What happens in West African cocoa farms directly impacts a Singapore-listed company selling chocolate in Indonesian supermarkets. For investors, this reinforces the importance of understanding these linkages and positioning portfolios to benefit from long-term trends while managing short-term volatility.